Ladies and gentlemen, a wonderful good day. Vancouver here this morning at the Cambridge House Show, and with me here is Dean Taylor, the president and CEO of Diamcor, a diamond producer out of South Africa. Yeah, and Dean, wonderful. Good morning. Thanks that you're taking the time. And diamond producer out of South Africa. Give us a short overview about the company, please.
It really is a very unique company in the sense that it's a very high-profile project. We're directly adjacent to DeBeers' flagship Venetia in South Africa. We are a diamond producer, which is quite rarefied area right now. We're looking to go 24/7, and of course, we do have a strategic alliance, and they're funded largely by Tiffany Co. So
as we see here on the back.
Yeah, exactly. Yeah, it's everything. This has been a 6-year process. A very experienced group of people taking non-core stuff that's production ready from DeBeers in very sensitive areas, of course, being right next to them, and putting those projects into production. With the idea of being very high quality diamonds and producing diamonds for the supply chain for the Tiffany's stores throughout the world.
Okay. So that you said you're already producing, but you wait for the 24/7. That means that requires a permit, right?
Yeah. So where we sit right now is it took us about 3 years to acquire the project. We were handpicked by DeBeers out of a group to acquire it. Then the next 3 years to build out the entire infrastructure, so all the water, power lines, roads, extensive build out for and very large plant, 800-ton-an-hour plant. That all is put in place and is ready to go. And over the last few quarters, we've been testing and commissioning, getting ready to go 24/7. And we produce about 2,000 to 2,500 carats a month now. So we've sold off about 15,000 carats to date. Our largest stone being, we get some big stones, good quality. The largest one was in October. We recovered a 91.7 carat stone.
How big is that 91 carat?
You're looking at
like
you're looking about an inch and a bit. So very good quality stones. Those one-time revenues we don't build into our overall projections, but we certainly expect on a quarterly basis as we get going, we'll see a lot of large stones. Now, permitting-wise, we've been working on getting the finalization for the 24/7 in place for the last couple of years. We expect, we'd like to try and we would have loved to have seen it before the end of the year, but we're going to try and clean that up and get that done in the next quarter or so. And once that happens, then we'll start to ramp up to our production targets for year 1 and 2 and keep growing the project up.
Perfect. Let's come to production costs, because this is key in all the discussions we have so far, especially in the gold space. But now you're on the diamond space. I think our viewers maybe not so really used to the diamond space. But can you give us an idea? What are your production costs per carat? What are you selling for? What is the margin?
Sure. When we look at it overall, we'll break it down. First of all, I'll tell you, like when we look at tonnage, just straight how much it costs per ton. All-in costs, everything included, we operate at probably around $4 to $5 a ton operating costs, about $15 to $18 a ton in revenue. Now that doesn't include any kind of large numbers we would see off of a large stone coming in. Those would be on top. On a carat basis, out of the 15,000 carats we've recovered and sold to date, we're about $208 a carat on average. The cost of producing that carat, probably around $40, $45.
So it's a very healthy margin.
It's a very healthy margin. Of course, like I said, we look at it, we want good, steady revenue. The run-of-mine average is key to us. We see, large stones as being something that's just a bonus. So when we look at our current share structure and things, a $3.5 million stone is a 10 cent a share earning event. So it is a very exciting time for us.
Yeah.
So.
And of course, you have not built this into your model. That's on top. No, that's an add-on.
That's true. We look at if we were to get our 24/7 this quarter, the idea would be to do somewhere in the neighborhood of we would ramp it up to do about maybe 10,000 carats a month, get to that goal in year 1, and then continue on up to 20,000 carats a month. That gives us an estimated, we're targeting about a 15-year life of mine. There's a tremendous amount of growth additional to that. But even if we look at those numbers, we think our fiscal year, our year end is March 31st. So starting, say, from April of this year through year 1, we would expect to see somewhere around 20 million in gross without large stones, 40 million in year 2. And those numbers translate into, we're talking 20 to 40 cents a share in earnings in year 1 and, 40 to 80 cents in year 2. So the company is very tightly held. It's a well-structured company, and the idea is to generate not only revenues and production and earnings and things like that, but we'd love to see ourselves in a position very shortly to pay dividends as well.
Oh, pay dividends. That's one of the keywords I love to hear. But first of all, what is management's share in the company? What is your shareholder base? Because you are quite tightly held, right?
It's about 15%. I mean, in a fully diluted scenario, maybe management might have as much as 20%. Tiffany's is a 10% owner. It is very tightly held. We have 35 million shares, 41 million fully diluted. So it's something that everybody is duly motivated, and obviously dividends is the lowest tax bracket. So a lot of guys we like that theory. So.
Just to give us an idea, I think your stock price is now something like, what is it, $1.40 or something, right?
$1.60 Canadian in that range. Our range this year, we've had 8 consecutive quarters of increase in not only the share price. So while all the other juniors have been sort of floundering, our stock has performed very, very well. But really, the key is look, we've focused largely on getting this into production. The idea is we were funded by Tiffany's, so not really looking to raise a whole bunch of money outside of those avenues. And the real value play here is amazing. It's about a $55 million market cap at this point. We're targeting, the target is somewhere between $1 to $1.2 billion in gross revenues over 15 years, with a good chunk of that coming back in earnings. So
there's room upwards.
There's a lot of room, and we've really only drilled out about 400 hectares of the just about 6,000 hectares that we have permitted. So that not only with such a low capex to get this into production, the deposit is very near surface, so it's a very low cost deposit to get at. It's directly adjacent to the source, so we know the diamond quality and where they've come from. They haven't moved a tremendous amount. So really, there's just a lot of upside where, with such a low capex, the idea is we put the plant in, we go to production, that helps our supply chain. It gets cash flow, all these different things, and then we still have a tremendous upside where we can now go and continue to expand that resource, and then consequently we'll look at expanding the project even further in terms of production in years 3, 4, 5.
Yeah, so if I get you right, also from the earnings side, it's possible that you can get easily something like 50, 70 cents per share earnings, right?
Yeah, I mean, in our year 1 calculations, just, at this point at 2,500 carats, ballpark, we're maybe break even or even a little bit profitable before we even go into production. So it's quite amazing. Now, year 1, we would expect, somewhere in the 20 to 40 cents a share in earnings range. That's the target we're looking at. We'd like to, we think the potential's there for that. And year 2, we simply doubling up the production. We think potential of 40 to maybe as much as 80 cents a share in earnings is possible.
Yeah. But this would mean that you can easily pay then something like 15 or 20 cents dividend, right?
I think at least. I think when we look at it, a good dividend policy, you want it to be sustainable. You don't want to put it in place until you're comfortable that the production is stabilized and things like that. But realistically, a lot of guys will take and, say they want to do a third, and, some will say they want to do 50%. Certainly our bigger shareholders would love to see us dividend more out. We see the other, when we look at dividends in general, we see it sort of establishing or trying to get an established dividend in place, and then perhaps treat the large stones as more of a special dividend type of thing, because we can get stones, our expectation, they're the largest to date at Venetia is about 315 carats. We assume that they get stuff in the 200 carat range. We've already recovered, of course, in just initial testing, getting stones up in, $1 million stones into the, the $100 carat range. And those stones, they can range, if they're good quality, they can be anywhere from 500,000 to as much as 10 or 15 million. Exactly. So when we see that kind of an influx of capital come in, that would be a situation where we might look at it and say, okay, well, this might be time for maybe even a special dividend. Yeah. So there's all kinds of opportunity here. The key now is to focus on getting the thing built out and the mine completely in place, which we've done, and now we simply kind of tread water here at this level until we can increase our production from sort of 5 days a week, 8 hours a day, to bringing it up to 24/7.
Yeah, perfect. Let's touch shortly on South Africa, because we are Europeans, we are very familiar with Africa, but I have sometimes a feeling they're a little bit concerned. Black empowerment. What is with Eskom going on? With the power supply. Can you elaborate a bit on that?
We've actually been, we're really lucky in the sense that in order for us to deal with getting acquisitions first from DeBeers, and also, corporate social responsibility issues, everything has to be above board when we're dealing with Tiffany's, DeBeers, and things like that. Our Black Empowerment Group is one of the oldest, most respected. It's called Nazala. There are actually 500,000 rural women shareholders, 100% women-owned. So it's very broad-based. So that's a huge benefit. Beneficiating the polishing facilities for Tiffany's are located in Johannesburg. That's a big positive. You know, we supply diamonds to the state diamond traders so that they can support polishing. That's a big positive. So just a lot of things in terms of the structuring of it that we've set up. South Africa in general, I mean, we hear lots of different things in terms of labor, unions and that. That's just largely it's a function where when we look at it, it's big mines that are marginal. You have a tremendous large workforce, and it's difficult to raise wages very quickly without laying people off, and that's sort of a conflicting goal. So our project's very small, maybe 80 to 100 employees max at any given time. So we don't really see much in the way of issues there. And so overall, I mean, we see it as a good opportunity to take a project that's ready to go into production, advance it, and for a company our size, it's very, very attractive. So perfect. South Africa, it's we would never look at areas of certain problem areas in Africa. I mean, if you look at some of the best countries, South Africa, Botswana, all these different areas. There's good areas and there's bad areas. We just try and stick to the good areas.
I think you're in a very good area. Yeah. Just to give us an idea, how does it work with security? You said you're very close to the Venetia Mine of DeBeers. So that's the largest in the world, I presume, nearly? Or third largest?
Largest producer in South Africa.
Yeah. So I mean, they need a lot of security, of course. Are you protected through them too, or how does it work?
Our plant is actually, when we say we're adjacent to, a lot of resource companies we'll say we're next to, and they're 20 miles. Yeah. Our plant is less than 1 kilometer from the actual pipe of Venetia, and you basically get to the main gates of Venetia. You either go straight through to Venetia, or you turn left, go through our security gates. Mm-hmm. Our plant in that is approximately around 11 kilometers inside the outer security fence of Venetia. Ah. So
you're benefiting of that.
Yeah, there's a tremendous benefit for us having that. In going back to even power, when we look at it, this year, in year 3, we've now got our own dedicated. We put in a 13-kilometer, main power line. Yeah. So we were running on big gen sets, very expensive on diesel. Those now have been converted over to backup power. Oh, so wow. Not only do we have a main power line, dedicated line from Eskom in, which was great to get, and obviously lowers costs, but we also have backup power should there be any issue with any kind of power supply at any given time. We automatically have backup power on everything. So
it sounds all is comprehensive, all is very well organized. It works.
It works really good. We're excited. Right now it's just go faster, and really the focus is
dividends.
Yeah, I mean the whole thing. It really the way it plays out now is we see that at $55 million market cap, we think it's a very undervalued,
quite low,
not well known story. Yeah. As it becomes more well known, we think it'll move up. So when we look at things right now, short-term thing, let's continue to maintain 2,000, 2,500 carats. Let's see if we can get some big stones, get some additional revenue from that. Let's get the 24/7 in place, and we're ready to ramp. And let's get going. So great. It's an exciting time.
Great, Dean. We wish you all the best for that, and we hope to hear soon more from you.
No problem. Thanks for your time.
Thank you very much. Great. Ladies and gentlemen, you heard it. That was Diamcor. It was Dean Taylor, the president and CEO. Diamond production in South Africa, profitable already, even in the setup phase, and they wait for the permit to go 24/7. So watch out for the company, make your own due diligence, visit the website. That was it from Vancouver. Thanks and bye-bye.